3, 2, 1. Welcome to the show.
Hey, look at that. It's 11 o'clock. Time to check the market.
Is it really?
All right.
They
Welcome to
can't
the
hear
show,
your
indeed.
alarm.
Oh, they couldn't hear it?
No, I couldn't hear it.
Well, the alarm went off because it's 11 in the morning, and I have it set to check the market at 11 a.m. and 3 p.m. just to make sure I don't miss anything.
And you usually are checking it at 12
6
and 1
6 a.m.
and 7 and 8. And
Yeah. Yeah, I know.
That's just in case you're driving along.
I might be a little fixated. Yeah.
Yeah.
So, yeah, I'm actually trying to get the podcast done here on Friday morning. I'm heading out to Penn State for the Penn State WVU football game.
You got your
Saturday.
Penn State
dad shirt on. Yep. They got Penn State over WVU by 20.5 points.
Wow.
So, yeah.
That's going to be a good game. I'll be watching on ESPN. I'll see if I see you in the stands.
Yeah, you might see me. I don't have anything white, and so you're supposed to wear white if you're on the Penn State side, and so I'm not sure exactly what I'm going to wear, but...
Well, don't wear yellow.
I'm not wearing, yellow and gold. Yeah. So, yeah, it should be a good weekend. And it's Labor Day, so everybody's out doing burgers and whatever. All right. So, podcast this week, we got a really interesting question that came in, and it kind of goes to, I think, Bollinger Bands. And so we're going to link those two together. Bollinger Bands is something we've talked about a couple times, but we're going to do a little bit of a deep dive into that. And then this idea of liquidity, depending on how far down the financial YouTube rabbit hole you go, you've heard of this term liquidity and how important it is. And I found an indicator in TradingView that can help us look at liquidity. And so we can see whether central banks and banking institutions are pushing capital into the system versus taking it out. Generally, when they're pushing it in, stocks go up. When they're taking it out, stocks tend to go down. Bonus chart is Tesla, and then a couple things on the weekly TSP fund charts. Okay, so a question comes in. You guys mentioned something in the August 20th podcast. Might be worth exploring further on a podcast, newsletter, webinar. Measuring a price offset as a percent of total from the simple moving average. This is a pre-calculated line we can add to a stack in stock charts. He's asking, can we do that? I suspect it's very closely related to the indicators you already have in the stack. If so, it may be of no value in terms of decision making. If it does have value, maybe it would help folks to see what their exposure is at any given time, either positive or negative, and maybe when to get out if things are too heated for their personal circumstances. So what he's basically getting to, I think, is in general overbought or oversold conditions, right? How can we tell if price gets too far above that? We use a 20-week moving average line on the weekly charts, right? If price gets really far above that line, how high above that line is too high where if you just looked at that indicator by itself, it would say maybe it's time to take some profits, right? Or if it got too far below the line, maybe it's time to think that the market's bottoming. And so I don't know about, I got the idea of the equation that he put here. And so what I think it's going to is Bollinger Bands. And so we're going to do a little bit of a deep dive into Bollinger Bands, but this is what it looks like if you put it up on a chart. And what it is the yellow line is the 20-period moving average line. So in this case, it's a daily chart of the S&P. 20-day simple moving average line. And then this line is 2 standard deviations above the median line, the 20-day moving average line. And this is 2 standard deviations below it. And so it just keeps going along. So we're going to kind of get into it. Okay, so Bollinger Bands. What they are and what they actually tell us. So it's a technical analysis tool defined by a set of trend lines plotted 2 standard deviations, positively and negatively, away from a simple moving average, a security's price, right? But which can be adjusted to the user's preference. And this is from that article in Investopedia. So Bollinger Band, it's a technical analysis tool, generates oversold and overbought signals, was developed by John Bollinger. The guy's amazing if you look at his work. Actually, He was at that conference that I was at earlier in the year. 3 lines compose the Bollinger Bands, simple moving average, or the middle band that we showed, it's in yellow, and the upper and lower bands. Upper and lower bands are typically, the standard setting is 2 standard deviations from the 20-day simple moving average, and you can modify it. When price continually touches the upper Bollinger Band, it can indicate an overbought signal because it's 2 standard deviations from the average, basically, right? The 20-day moving average. If the signal continually touches the lower band, it can indicate an oversold signal. Okay. So approximately 90% of price action occurs between the 2 bands. Any breakout above or below the bands is significant. The breakout is not a trading signal, as many investors mistake, that when price hits or exceeds one of the bands as a signal to buy or sell. So it's not by itself a signal to buy or sell. Breakouts provide no clue as to the direction and extent of future price movement. So limitations, right? This is Bollinger saying it's not a standalone trading system. It's just one indicator designed to provide traders with information regarding price volatility. Bollinger suggests using them with 2 or 3 other non-correlated indicators to provide more direct market signals and indicators based on different types of data. So some of his favorites that we use all the time, MACD and the RSI, relative strength indicator. So because Bollinger Bands are computed from a simple moving average, they weigh older price data the same as the most recent, meaning that new information may be diluted by outdated information, which is why we use the exponential moving average in our stack. It takes into account more recent price data rather than averaging older data the same as recent data. Also, the use of 20-day simple moving average and 2 standard deviations is a bit arbitrary and may not work for everyone in every situation. Traders should adjust their SMA and standard deviation assumptions accordingly and monitor them. Okay, so bottom line, Bollinger Bands can be a useful tool for traders in assessing relative level of over and undersold position of a stock and provides them with insight into whether to enter or exit a position. Certain aspects of Bollinger Bands, such as the squeeze, we're not going to get into that. Okay. So this is a chart of the S&P, daily chart, with Bollinger Bands set as the default. And so just a couple things to point out. Some people really like Bollinger Bands. It's not my favorite indicator. I just can't get my mind around how it's going to be valuable. But it doesn't mean it's, a lot of people use it. So if we start back here in December of last year, we got outside the Bollinger Band right there. And the next day we got outside it again. So perhaps on its own, it did say that you want to use other indicators to go along with it, but for the sake of simplicity, I'm not adding other indicators into this. We're just looking at it in terms of Bollinger Bands. Exceeded that 2 standard deviation line 1, 2, 3, 4 times. Right, so somewhere in there, presumably, you would have sold. We had a little bit of a pullback, and price continued higher. So I don't know if I would call that a failed. I mean, I don't know what to make of that. It got outside that 2 standard deviation, and price continued to go higher. We got outside it here on the upside, and then price came down. That was good. We got outside on the downside here, and price keeps going down. So I don't know. If you got out on the first one, if you're in the stock funds, let's say, and you get out on the first tick outside of that 2 standard deviation to the downside, right? Because all the price action, 90% of the price action happens between these blue lines. So if you're outside of it, it's saying that that the market is oversold, and so actually that would, theoretically be a time to get in. But the market keeps going down. Same thing here. When it gets above the Bollinger Band, the idea is it's overbought, and so you would sell it. And it would be good for 2 days, but then the market keeps going up. So you'd be out while the market's going up because you sold it here. So hopefully you guys are getting the idea. I just, and maybe there's a way, I'm sure there's a lot more into Bollinger Bands than what I'm kind of putting out here. The squeeze is certainly a thing. When the bands start to expand, it means a certain thing. When they start to contract, it means a certain thing. The market's getting ready to break one way or the other. But, if you looked at this, most recently we got oversold there in the beginning of August, and the market kept going down. And it kept going oversold. So when would you know when to use this as an indicator to get in or out? I just don't know. You can certainly ride the upper Bollinger Band for a long time. When prices are moving higher, it can ride that for a long time. And it can ride it on the downside. So, I don't know. If you guys have thoughts about Bollinger Bands, definitely put them in the comments. But that's the idea of the 2 standard deviation, the standard. So on this one, I expanded it to 4 standard deviations. So I also tried a 3, but just for the sake of comparing them, the 4 was kind of better. So nowhere from December of last year to now did price get so overbought or so oversold that it hit the 4 standard deviation line. Maybe if it hit that line, it would be so extremely overbought or oversold that it would be a really, really valid indication of a top or a bottom. But I don't know. Okay. Any thoughts about Bollinger Bands and that question?
I don't have any thoughts. I mean, maybe our audience will.
Yeah, I know there are people that like it.
Very useful depending on what you're trying to do.
Yeah.
And it's just another tool. And again, if the tool doesn't speak to you, it's probably not great. If you really can't wrap your head around it, then it's not as useful for you.
Yeah, I'm not saying it's not useful. I'm just saying it's not useful for me.
Yeah, right. I mean, that's the way it works, though. You know, is you've got to find you. I don't think you should ever rely on one indicator, right? And so if you can take that and build from it, say, hey, I really understand Bollinger Bands, and build from that with some other kind of supporting indicators, I think you're onto something. Right.
Yep,
I think
absolutely.
that's the way to do it. And that's kind of the way you've started, right? You start with moving averages and trend lines, and then you kind of start laying on other things, right? The Elliott wave count, then, the RSI, the MACD. You start layering those things, and some things are weighted heavier than others. And that's how you find your kind of sweet spot with all this.
Yeah, no, I totally agree. All right. So switching gears, this idea of liquidity. So this is a pretty good article from Forbes if you want to kind of get an idea of how money goes into the system. So while Wall Street and Twitter's legion of Wall Street wannabes are busy predicting when the Fed will call it quits on rate hikes, the real pivot in monetary policy might have slipped right under their noses. So this was actually back in February of this year. Okay, so it's kind of an old article. So global liquidity, a measure of how much money is sloshing around in the financial system, has been on an upswing since October, right? That's last October. According to research from Cross Border Capital, the uptick may explain why stocks, Bitcoin, and gold have rallied despite central banks' warnings that they aren't about to let up on rate hikes. So even though everybody is fixated on the Fed, and the Fed is definitely important, but just because the Fed is continuing to hike rates doesn't mean that liquidity is being drained from the system. It's one of the things that would add to, that would pull liquidity out of the system when the Fed raises rates. But in terms of the global liquidity, it's not anywhere near the only factor. So on Wednesday, the Fed, this is back a long time ago, that Wednesday the Fed raises rates again by a quarter point, gave no indication that it would halt the timing cycle anytime soon. And as we know, it's been continuing to raise rates until as recently as this last Fed meeting. So what we monitor is whether central banks or banking groups are feeding liquidity into the pipes. There's been a de facto change since September. So what caused the change, at least for the Fed, was the recent debacle in the UK sovereign debt market. So if you guys remember back, the UK bonds tanked. It was a very big deal in Europe, but it didn't have much of an effect over here. Investors sold off the UK government bonds amid dire economic outlook and political uncertainty. What ensued was what many analysts refer to as a meltdown in what has historically been one of the safest corners in all of finance. And if you don't think the glitch was serious, it ended up costing the prime minister her job. So it's no surprise central banks are less concerned about reining in inflation than they are about keeping the financial system's gears greased. Okay, this is really the kind of the important thing. You can hear a lot of people talking about the Fed and all that. Rarely will they talk about both the financial system and inflation at the same time. So it's much more important to keep countries' financial systems going than it is to worry about bringing inflation down. So I think the most important factor above anything else is the integrity of the sovereign debt market. That's what this is all about, really. If you get a blast like you got in Britain in the U.S., we've all got a problem. If that happened in the U.S., world financial markets would have crashed. You might say very loosely that we're moving toward a world of yield curve control. Inflation is an issue, but it plays second fiddle to the workings of the sovereign debt market. So that's kind of a precursor almost to what we have going on right now. If treasuries, the U.S. Treasury bond market starts to have problems like they had in Europe last year, it's going to be a much bigger problem for equities and the markets around the world. So the idea of tracking liquidity isn't new. Howell cut his teeth at Salmon Brothers in the 80s, told Forbes that measuring capital flow is key to the firm's trading success. No less a personality than billionaire investor Stan Druckenmiller has said that it's liquidity that drives markets. Druckenmiller, you guys might remember, we did a show that included him and a couple other guys that were really talking about serious concerns that they had for the market going forward. Measuring capital flow is easier said than done. Howell told Forbes that calculating bank deposits was once enough. You could figure out how much money is going into banks, but decades of financial innovation and the rise of shadow banking have turned a simple calculation into an esoteric exercise. That may explain why a lot of investors are still waiting for a train that's already left the station, right? So if you think the Fed is raising rates, which I think the general consensus is the Fed's raising rates. And so if the Fed is raising rates, it costs more to borrow, and all this is true. It costs more to borrow. Eventually something's going to break in the market and all that. At the same time the Fed is raising rates, the global liquidity can also be rising. And when global liquidity is rising, the markets are going to go up, regardless of what the Fed says. And so if we look at it on a chart, it's not a day-to-day thing. You have to look at it as a trend. So this is an indicator of the global net liquidity. Okay, so it's in the world. And this is the S&P 500 weekly. Okay. So here was COVID. We had a giant spike in liquidity to save the world from COVID, right? And it kept going. They kept pushing liquidity into the system, and what happened? The market kept going higher. As soon as liquidity started to flatten out, that was the top, right? Liquidity's been going down, market's going down. This is interesting. Market's going up, liquidity's going down, right? We're going to get to it on the weekly charts at the end, but just kind of keep this chart in mind because this section right here of gains, this is the S&P 500. This section in gains happened while liquidity is going down, which is pretty interesting. And the majority of this gain is on the 7 companies that we've been talking about, right? NVIDIA, Apple, Google, Facebook, can't remember, 7 companies. Okay. Bonus chart is Tesla. We've talked about this before, but it's actually today, Tesla's not doing great. It's pulled back quite a bit today. But if we start back here, when Tesla first started breaking out, We had a 1, 2, 3, 4, 5 for a top in Tesla, an A, B, C down to the 786 retracement level for a 2, and it was at $100. Like, that was an unbelievably great time to get into Tesla if you saw this chart. Since then, we had a really strong move up to the upside, an ABC correction, and right there would have been another great week to buy into Tesla. So that's what it looks like on a big picture. If you kind of drill it in a little bit to a daily chart, we had that really good opportunity there at $100. Came up, ABC correction. So anywhere in here would have been, anywhere in here would have been a good time to get on board. Once you saw that this, we put a low in here, a higher low here, say right there would have been another great time. Tesla moves up, corrects back down. Now we have 2 points, or if not 3 points, to draw a lower channel line. And it's parallel to the upper channel line. It's a really, really good channel for Tesla. And then this week, it's hugely moving to the upside. So if I'm looking at this chart of Tesla, I'm expecting, if you extend the lines out, 350 on Tesla. If it just continues with the pattern that it's doing, right? And if you got down here below this line, the trend has obviously changed and you would get out. So if you were able to get into Tesla back in here, let's say, your risk would only be that much and your potential gain is that much. So that's how you'd use it. All right, TSP fund charts. So it's a weekly chart of the S&P, a little bit different than what we usually put out, but I wanted to point out a couple of things. So you got the 20-week moving average line in blue and the 50-week moving average line in red. So a lot of people talk about the crossovers. If the 20-week in blue is above the 50-week in red, and they're both rising, the market's moving higher, right? It's just math. It's the way it works. If red is over blue, you're good. The market's going higher, right? If red is over blue, right, not good. That's a bear market. A lot of people, there's the death cross and the golden cross. So death cross, when a smaller moving average line, in this case the 20-week, is crossing down through the 50-week, right? Those points in the short term tend to be lows, actually. There tends to be recovery off those points, but in the longer term, they're significant. This one back here, once that crossed, that was the beginning of the bull market, or confirmation of the bull market that we're in now. The other thing I wanted to point out is kind of goes to divergence that we're talking about all the time. This is a little bit different way to see it. So this curve of relative strength, the relative strength is clearly topping and rolling over here. And it's happening as price is moving higher. So it's, if you zoom out on a pretty long weekly chart, you can kind of see that the tendency of the relative strength is going down even as price is going up. So obviously it's not a great timing tool, but it's telling you that you're getting closer to a top than you are a bottom up here. And it was the same thing at the low down here. We got price here, RSI down here, price lower, RSI higher, right? So you get the price continuing down as RSI is turning back up. It's a great indicator that you have a bottom getting ready to happen. Okay. S fund, same kind of thing. You got a huge top back here in relative strength at this high in the S fund. And then as price continues higher in the S fund, RSI is tanking, right? So it's not an exact timing tool, obviously, but it's a really good indication that this is leading us to a top, not to a bottom. And then the same thing, we got this turn up in relative strength here. At the same time, we had that lowest point in price. So it was telling us that a bottom was coming, not a top. iFund, same kind of idea. RSI top happens back here before the top in the iFund. And then as it's rolling over, you get RSI declining here all year this year as price is going higher. It's not good. It's not a good setup for the iFund right now. So we talk a lot about the dollar in the iFund. If the dollar continues higher, the iFund is going down. And it's, we got a sell trigger last week. We got below 50 RSI and below that 20-week moving average line. So the iFund in the big scheme of things is not looking very good. F-Fund, same kind of idea. This is a pretty clear one. The crosses, there are very few of them. So we got to cross over to the upside here, and the iFund or the F-Fund continues higher, right? Once we get across to the downside, we've been in this red line over the blue line, and we're still there. And it's expanding. So bonds, as much as people want to get back into them right now, bonds are not the place to be. They're not going to be the place to be until we get a cross back. The blue line gets back above the red line. And the crosses happen so infrequently that when that cross does happen, it's going to be significant. It is going to be the time you want to get back into the F-Fund. Questions?
As always, if you have any questions, put them in the comment section wherever you find the video. If there's not a comment section, you can always shoot us an email at support@growmytsp.com, and the support team will get it over to us.
Yep, the questions help. They definitely give us stuff to focus on.
Yeah, so. And there's a lot of people out there with questions, so it's great for us to be able to kind of interact. I wish we could just take callers.
Yeah, that would be awesome.
Do this live and you guys call in. Anyway, if you like the video, share it with your friends. If you don't, share it with your friends anyway. And we hope you guys all are having a safe Labor Day weekend.
Yep.
And we'll be on the road the next week, and Jerry will probably be doing the show by himself because I will be on the motorcycle.
Yep, excellent.
All right, guys.
Enjoy.
Be safe, and we will see you later. Oh, yeah. Hold on.
Hit the right button?
I got to get the right button.
There you go. Dun, dun. All right.